Won't be fooled again by the WHO. Here on Democracy Now!, democracynow.org, the War and Peace Report, I'm Sharif Abdul Quddus. One of the key terms to come out of the nation's economic meltdown has been too big to fail. The government has funneled billions of dollars to large financial firms by arguing that their collapse would deal an irreparable blow to economic recovery. Well, a new study has calculated the tab of the too big to fail approach, and it amounts to a far larger taxpayer-funded subsidy than previously thought. The Center for Economic and Policy Research says the bailout has allowed too big to fail banks to pay significantly lower interest rates than those paid by smaller banks. According to one estimate, that's meant a subsidy for the nation's 18 largest bank holding companies of $34.1 billion a year. That amount represents nearly half of these companies' combined annual profits. For more, we're joined by the study's co-author, Dean Baker. He's co-director of the Center for Economic and Policy Research and the author of several books, including his latest, Plunder and Blunder, The Rise and Fall of the Bubble Economy. He also runs the popular economics blog, Beat the Press. Dean Baker joins us from Washington, D.C. Welcome to Democracy Now! Can you first explain the essential finding of your study?
Well, the basic story is a very simple one. We got data from the Federal Deposit Insurance Corporation on the cost of funds, and they broke out the 18 largest banks, the ones we looked at, all with assets of more than $100 billion, and compared their cost of funds with all the other banks in the system. And they found that on average their cost of funds is about 0.8 of a percentage point less. Now, it typically is somewhat less. In other words, the big banks typically pay somewhat less than smaller banks. So what we did was we simply looked at the difference in that difference. So how much is that gap today, the last 3 quarters when we've, post-Lehman, when we've in fact formalized this too big to fail policy, as opposed to what it had been in prior years. And we found there was a very substantial increase in that gap, about 0.5 percentage point, and that comes out to about $34 billion a year in annual subsidies, as you had mentioned. So it's a pretty sizable interest rate subsidy. Again, I should qualify this by saying it's a very crude estimate. I won't swear that this will hold up through time, but it's sort of a first effort to take a shot at how large this subsidy is.
And explain in layman's terms what you mean by the cost of funds. This is the interest rate that banks pay to attract depositors.
Exactly. So what's going on, if you or I go down, we deposit $5,000, $10,000, $20,000 in our bank, that's insured by the FDIC, the federal government, so we could feel pretty safe on that. At least it's as good as the government. Now, if we had, let's say we're a big investor, we're a mutual fund, whatever it might be, and we have $10 million to place somewhere, well, if we go to a small bank, we're worried. We have to look at them. Are they safe? Are they following good practices? They could go out of business. We would then lose that money. On the other hand, if we go to one of the big banks, a Citigroup, a Bank of America, and we put our $10 million there, we basically know at this point the government is going to come in and bail it out. So we look at that $10 million on deposit with Citigroup or Bank of America almost the same way as we would look as buying a government bond.
And name the banks that are profiting most from this taxpayer-funded subsidy?
Well, basically, the biggest banks profit the most. So if you look at Citigroup, Bank of America, Wells Fargo, I'm missing one in there, the big four, J.P. Morgan. The bigger the bank, the more you profit. Now, how large is it relative to their profits? You have some banks that it amounted the full amount or even more in their profits. Capital One, for example, I believe the subsidy by our calculation was actually more in their profits. So it's basically the story is the bigger you are, the more money you pocket. How large that is relative to your profits depends on how profitable the bank would otherwise be.
Now, this issue of too big to fail, many are arguing that the taxpayer-funded bailout created what's called moral hazard, where banks can take excessive risks knowing that they'll be bailed out if things go wrong. We've seen now a year later that many of these too big to fail banks have become even bigger. They're still trading in these credit derivatives that are largely unregulated. Are we setting ourselves up for a bigger fall here?
Well, not necessarily a bigger fall. I mean, there was a lot that underlie this. First and foremost, a housing bubble that reached $8 trillion, and we're not about to reproduce that overnight. But we don't have a situation in place that will prevent it. And at the very least, what we're having here is, in effect, a subsidy of the large banks at the expense of small banks or smaller banks. Maybe the smaller banks are still quite large. But the point is that if you're a Goldman Sachs, if you're a Citigroup, you could borrow and people are happy to lend you money with the understanding that if things go bad, the government comes in and bails you out. And Goldman's a great example here because they're basically doing exactly what they did before the crisis. That's explicitly what Lloyd Blankfein, the CEO of Goldman, said. You know, they're operating the same way. They're taking risky trades, in some ways more risky than they did previously. Thus far, they've paid off, and what that's meant is they've paid big bonuses to their paying big bonuses to their top people. They're getting, I think it was $9 billion in bonuses going to their top people this year. But of course, if they make mistakes, well, we're on the hook for those mistakes.
And in your study, you make a comparison of the subsidy provided by this cost of funds difference, and you compare it to things like the grants given to the temporary assistance to needy families, to foreign aid. What are some of those numbers?
Well, it's temporary assistance for needy families. That's the main welfare program that, you know, people often talk about. That's around $18 billion. So we're talking about nearly twice as much going in subsidies to the too-big-to-fail banks as go out in the main welfare program from the federal government each year. Foreign aid's around $25 billion. So again, we're now talking about somewhere around 30% more going to the biggest banks. So we have a lot of people that will get very upset about money going to foreign aid, money going to needy families, thinking that that might not be a good expenditure. But the point here is we're giving much more money to Goldman Sachs and Citigroup, Bank of America, than we are to foreign aid or to needy families.
And is this subsidy essentially keeping some of these banks in business?
Well, it's hard to say. Certainly last fall it was. If you know, the federal government had just sat there with its arm crossed and just said, well, you know, you guys got yourself in trouble, you deal with it, well, almost certainly Citigroup, Goldman Sachs, Bank of America, many of the others, big ones, would be out of business. Now, as it stands today, they've had a couple profitable quarters. One of the ways, sort of an indirect subsidy, it's good for the economy, but certainly helps the banks. They could get money at essentially zero interest through the Federal Reserve Board, and then they lend it back to the government. They could buy 30-year or 10-year bonds at 3.5%. This has created a situation which are much, much more profitable today. So if we were to somehow convincingly say, you know, too big to fail is no longer there, if Citigroup gets in trouble, they're out of business, I don't know if at this point that would mean they would go out of business. It could. I just, you know, you'd have to look at their books much more closely than I have, or probably that we'd have public access to.
We're talking to Dean Baker, co-director of the Center for Economic and Policy Research. I want to turn to the issue of jobs. The nation's unofficial unemployment rate rose to 9.8% last month, and the Labor Department said 263,000 jobs were eliminated in September, bringing the total number of workers unemployed to 15 million. I want to turn to some of what President Obama had to say on Friday after the announcement came out. Let's take a listen.
Today's job report is a sobering reminder that progress comes in fits and starts, and that we're going to need to grind out this recovery step by step. From the moment I took office, I've made the point that employment is often the last thing to come back after a recession. And that's what history shows us. But our task is to do everything we can possibly do to accelerate that process. And I want to let every single American know that I will not let up until those who are seeking work can find work.
The Labor Department also announced it had severely underestimated the number of jobs lost between March 2008 and March 2009. The department had originally said about 4.8 million jobs were eliminated during that period, but now officials admit an additional 824,000 jobs were lost. Dean Baker, the significance of this announcement.
Well, what it indicates is that the recession has been much more serious than the official data showed. I should point out, it actually wasn't a surprise, at least to some of us nerdy types. It was, you know, it's not that they were tinkering with the books. It's just the nature of the survey. It was likely that it had underestimated job losses. So this was something that really analysts should not have been surprised by. Analysts specialize in being surprised, it seems. But in any case, it was a predictable result. It means that the downturn was more serious in terms of jobs lost, or over 7 million down for the cycle to date, if we carry it through the latest numbers through September, which means we're in a really, really deep hole. And getting back to what President Obama said, I mean, it's important to understand, we say that jobs are a lagging indicator. That's true, but we have a really, really deep hole. And I think there's this view that somehow because the economy is growing now, which it probably is, I mean, I think we will see growth, that everything's on the up and up and it's sunny days are here again. But I don't know anyone who projects us to get back to normal levels of unemployment till at least 2013, and it could well be 2014 or 15. We're looking at a long period of high unemployment unless we see some very strong measures by the government.
And the issue of unemployment benefits?
Well, President Obama is proposing to extend them further, and I think that's a good thing. You get another 13 weeks, and also the COBRA, that they would pay 65% of people's health insurance, which again is a very, very big thing because most people unemployed can't afford their health insurance. So those are big things. But at the end of the day, however long we extend the benefits, we're still going to end up with a lot of people that are unemployed longer than those benefits because, even if they're a year and a half, even if they're 2 years, we're looking at high unemployment, as I say, through 2013 and maybe longer. You're going to have a lot of people that reach the end of those benefits, and it's not clear what they're going to have to support themselves.
Dean Baker, I want to thank you very much for being with us. Dean Baker is the co-director of the Center for Economic and Policy Research. He's author of several books. His latest is Plunder and Blunder, The Rise and Fall of the Bubble Economy. We'll link to his latest study at democracynow.org.